And with the Fed's latest rate hike, the gap between the federal funds rate and the Bank of Korea's policy rate is now the biggest it's been since the year 2000. That'll keep up the pressure on the BOK to keep tightening to prevent a further weakening of the Korean won. But it also has to consider the effects of higher rates on economic growth. Shin Ha-young reports.
The Fed's monetary tightening has widened the gap in key interest rates between South Korea and the U.S. to the largest in 22 years. At 1.25 percentage points, the last time the gap was this big was in the year 2000, and it stayed that way for 6 months. The Bank of Korea's next decision on rates is due January 13th, and it's under growing pressure to act decisively. Narrowing the gap is important because it's contributed to the dramatic weakening of the Korean won, which raises the cost of imports and adds to inflation. But one expert says the BOK could still decide next month to be less aggressive.
When it comes to monetary policy, the BOK has to consider not only the foreign exchange market but also the local economy. Considering the current economic conditions, I think the BOK is going to raise the rate by 25 basis points in January and slow down the pace of its rate hikes.
In terms of economic conditions, he pointed to the country's economic outlook for next year, which is projected to see a slowdown from this year. The BOK downgraded growth for next year to 1.7%, while the Asian Development Bank has downgraded to 1.5%. Meanwhile, South Korea's Finance Minister Chu Kyung-ho said in Thursday's emergency macroeconomic meeting that the Fed's latest move was in line with market expectations. He added that because uncertainty is still high due to inflation and the slowing economy, the government is putting more efforts into stabilizing the market through continued monitoring and communication. The same day, the BOK also held a meeting to review the situation in the financial markets and take action if volatility increases. Shin Ha-young, Arirang News.